Hey everyone, David Coe, the Coe Real Estate Group. Hey, today I brought on my friend Elizabeth Burros. She's with Gibraltar 1031 Exchange, and we are going to talk about 1031 exchanges. But more importantly, they're usually 1031 exchanges are for investors, but there is a way you can do it for your primary residence. So we're going to kind of get into that today. First of all, Elizabeth, thank you so much for joining today.
Thank you so much for having me. It's a treat.
Absolutely. Elizabeth was just a speaker on my one of my Phoebe panels as well, and there was so much great information. I thought this would might be a nice little kind of deep dive into this one specific rule on 1031 exchanges. But Elizabeth, before we get into that, why don't you give us a little bit of your overview, and then let's kind of talk about some of the basics of what a 1031 exchange is.
Absolutely. So basically, 1031, those four numbers, it's actually section 1031 of the Internal Revenue Code. So section 1031 is when you have a piece of investment real estate that you want to sell and reinvest those funds into another piece of real estate. You're able to defer capital gains taxes by doing a section 1031 exchange. In order to do this, there's a couple of rules that you have to follow, and you have to hire a qualified intermediary, QI, accommodator, all these kind of different names. That's my role in the transaction. I'm a qualified intermediary that
Which is
walks the
basically
client
just
through.
like an escrow company, right? You're just holding money as an independent third party source.
We're in addition to the escrow. So I always like to say we're like a secondary escrow to the transaction. So we can't take over any other job. So you're still going to use your escrow, your closing agency, your title, your amazing realtor, your mortgage broker. So we're in addition to all of the other parties in the transaction. So our sole purpose is we're a third party um, in the transaction, neutral third party, that we hold the funds during the transaction. So you sell your relinquished property, the funds are going to get transferred at the close of escrow to us. We safely hold them in trust for the client, and then we transfer the funds to the close of the replacement property. So we hold the funds in escrow, and we prepare the legal documentation required for both the property you're selling and the property you're purchasing. So we prepare the legal documentation, we hold the funds, and we walk the client throughout the entire transaction.
Yeah, and I know that, it has to be a like-kind property, which means if you're buying, if you're selling a commercial piece of real estate, or if you're just selling real estate, you have to buy real estate. But there are some rules and how quickly you have to identify and purchase that property.
Exactly. So there's a handful of rules. One of the rules you just mentioned is it has to be qualified use or like kind. So the property must be in productive use, as we say, so held for income investment or for trade or business. So you mentioned primary residence. We'll get into that in a little bit, but it has to be used for investment purposes. It can't be something that you're currently living in or your primary residence. And like kind, meaning it has to be real estate, real property in exchange for real property. A lot of people have a misconception here that has to be single residence in California or even in the same zip code in exchange for a single resident. That's not the case. It's any real property in exchange for any real property. So you can sell from residential into commercial, commercial into residential, single family into duplex, duplex into triplex. It's a really great way to diversify your portfolio, your real estate holdings, not only geographically, but also the type of real estate you're holding. So it's a really great tool for your real estate portfolio, big and small.
And you do still have to pay the taxes, but what this does is defers them, right? So whatever capital gain I have, I can defer it. And the strategy here is to keep deferring, deferring, deferring until you pass away. Then your heirs get a step up in basis and you can avoid having to pay that gain. Is that correct?
Exactly. It's that quirky joke of death and taxes, right? So
Mhm.
you're able to continuously defer throughout your lifetime. So if you continuously defer your 1031 exchanges, you sell property A, buy property 1031 into property B, sell property B, 1031 into property C. And let's say you hold property C up until your death. Your heirs will inherit it at a stepped up cost basis. And now you've what we call permanently deferred all those capital gains taxes. So we don't ever say they go away or they become exempt or you get away, they don't disappear, but they become permanently deferred. So it's a
Mhm.
deferment, but you can permanently defer them and never actually pay them. You have to die, but your
Mhm.
heirs inherit it at that stepped up cost basis. So it's a really great estate planning tool, and you're using that money to invest in additional property. So it's a great tool for yourself to better invest and diversify and grow your portfolio and make your money working for you instead of giving it to the government.
Yeah, I mean, look, that what is capital gain taxes now? 40% with state and federal, close to that?
Exactly. So all these capital gains rates that we're talking about differing, you have your federal capital gains, your state capital gains, it differs in each state, obviously. And then you have the NIIP and then depreciation recapture. So all four of these add up to over 40% potentially that can get deferred by doing a 1031 exchange.
And that's something where over the lifetime of whatever that portfolio you're building, if you can take that 40% and continue to invest it over a 30, 40 year, the amount of additional, net wealth you can build by not having to pay that capital gains tax is huge.
It's astronomical, quite frankly.
And
Yeah.
then how many days do you have? I know you have a very set schedule once you sell property A until when you buy and identify property B.
Yeah, there's three strict timelines that have to get followed in order to qualify for a 1031 exchange. The first one is you have to hire a qualified intermediary. You have to start the exchange process prior to the close of escrow of the first property that you sell. So we have to get involved. The paperwork have to get signed. You have to show intent to do the 1031 exchange prior to the close of escrow
Oh,
of the
by the way,
both of these
thanks for
properties.
shamelessly plugging my company. I appreciate that.
But um,
Yeah.
so that's number one. Have to get
Mhm.
started prior to close. And then the day you close escrow, you have 45 calendar days to identify potential property which you're going to purchase. And you have 180 calendar days to close on all properties which you identified during the first 45. So the 180 days total is what we call the exchange period. That timeline starts the day that you close escrow on the property you sold. And you have 180 days to close property and all potential properties you're going to be purchasing. And the first 45 of those days is the identification period. So you have to identify the properties during the first 45 days of the 180 days total. So all three
Cool.
timelines must be met in order to have a valid 1031 exchange.
And if you screw it up, then you have to pay the taxes. It's not like you go to jail or anything. But
No
you
jail
do have
time
to
and
pay that
luckily no
40%.
penalties. There are no penalties other than just the initial taxes that you're trying to defer in the first place.
Right. All right, listen, I'm sure we could talk about this for another half an hour, but I do want to
Plus,
get into the idea of exchanging your primary residence. Most people know that you do get an exemption of a capital gain. If you're single, it's 250,000. If you're married, it's 500,000. Well, that was a lot 15 years ago, but it's not that much now. We have a lot of people in the South Bay around the country that have, millions of dollars of equity in their home, and they feel like they're kind of locked in because they can't sell because they're going to have this huge capital gain hit. And this is absolutely a strategy. So I know you can do it, but how do you have to, if I own my own primary residence and I want to avoid or defer that capital gain, how do I do that?
great question. There's actually two ways that you can combine what we call a 121 exemption. That's that 250, $500,000 exemption in your primary residence with a 1031 exchange. So there's two different ways that you can combine the two and get the initial exemption and then the remainder deferred with your capital gains. So the first one we'll focus on is if you have a primary residence that you're looking to sell, ways that you can combine the two is if you have lived in it 2 of the last 5 years. So let's say you live in your primary residence, you move out and rent it out for 2 years. Now you've lived in it for 2 years, rented it out for 2 years. You can now combine that 121 and the 1031 to get the initial as a married couple $500,000 exemption and then defer doing a 1031 on the remainder of the capital gains. So
Mm.
that's a great tool, especially as you're looking towards maybe downsizing, retiring, um, even diversifying as your kids start to move out, ways to move out of your primary residence and start to look towards downsizing, or I just said that, retiring, um, and combining the 121 and the 1031 and not pay capital gains on all that equity that you've accrued after, owning your primary for decades.
So if I have $1 million of equity and I'm married, I automatically get the $500,000 exclusion. But by renting it for 2 years, and I think that's usually I know there's no hard, fast rule on this, but I think in general, you want to have at least two tax returns where you have a rental property. You actually are treating it like a rental property. You're collecting rent. You're separating it. You treat it as a cash flowing asset. Then you go through and do the exchange. Then you can take the other $500,000 of gain and just keep deferring that just like it was a regular investment property.
Exactly. The first 500 gets exempt, so that actually goes away, and then you've deferred the other 500,000. Exactly correct.
Cool.
Yeah.
All right. Well, hey, Elizabeth, I really appreciate it. I think there's a lot of people out there that don't know that's a possibility. So thank you for coming on and sharing info about the 1031 exchange and how you can do it for your primary residence.
My absolute pleasure. Ever have any questions, give me a call.
All right, everyone. Well, hey, thanks for watching. You can see Elizabeth's contact information here. We're going to put it down below as well. And if you ever need some help navigating it, contact me, contact Elizabeth. We'd love to help you out. So thanks so much, and we'll see you next time.